Hi, and welcome to the X22 Report Spotlight. Today we have a returning guest, Craig Hemke, also known as Turd Ferguson. He's been a securities professional for nearly 20 years. He's the creator and owner of TF Metals Report. He does podcasts. You can see his blog on tfmetalsreport.com. Craig, welcome back to the X22 Report Spotlight.
Hey, Dave, it's always a pleasure. Thanks for having me back.
Well, thanks for coming back. And we have been seeing crazy things in the market, in the economy. And right now, the stock market is down. It's fluctuating from day to day. And the start of this year, in 2016, we saw the market down, and then we've seen it being pumped right back up. Why do you think we're having these type of fluctuations? Is it still a free market?
Yeah, not to the extent that it used to be, at least, Dave. It seems to me that everything's driven these days by high-frequency trading computers. We've seen the data, that says 75, 80% of the volume on the New York Stock Exchange is now all done by these high-frequency trading computers that are just swapping positions back and forth, trying to nick each other for fractions of a penny. There's kind of this notion that the stock market, if you will, or really any market, is still human beings, making rational decisions based off of fundamental analysis, arcane notions like PE ratios, things like that. When instead these algorithmic programmed high frequency trading computers just take their cues as to whether buy or sell stocks or index futures based off of several inputs. In the stock market, you can watch it on a daily basis. It's either tracking maybe the VIX index. In 2016, the S&P futures have often been tracking crude oil, which is really kind of a strange one. And then, of course, the key input is the forex pair of the U.S. dollar versus the Japanese yen. After the first of the year, Mother Felon raised rates back in December, at least raised the Fed funds rate. Every other rate's gone down. That increased the dollar, which put pressure on the Chinese yuan, which is pegged to the dollar. In early January, the People's Bank of China began to devalue the yuan, which then subsequently caused a rally in the yen. And that rally in the yen is what caused these computers to sell stocks. And that's how that all worked out. And now we're probably 10% off the lows. The Federal Reserve Open Market Committee is meeting here today, Tuesday, and again tomorrow, Wednesday, cranking out their what we call the Fed lines, 2 o'clock on Wednesday. And the stock market for the year now is only down 1%. So, gosh, I almost at this point wouldn't be surprised to see if they try to go ahead and jack rates again tomorrow. We'll just have to see.
Do you think the economy at this point can take it if they jack rates? Because we see Europe, they're at negative. Japan,
yep.
A couple months ago, they announced negative, and now it looks like they might be reversing. They might be saying negative interest rates are over at this point. Do you think the economy is strong enough to take another rate increase?
Well, see, that's what's so funny about it, Dave, is, they allegedly raised the Fed funds rate, the very short end, by 25 basis points. But the 2-year note is down from where it was in December. The 10-year note was about 2.4%. Here it's now under 2. The 30-year long bond got up to 3%. Just recently was back down to 2.5%. And so all they've done is flatten the yield curve. And from any traditional economic sense, anybody that's listening to us that took Econ 101 in college, one of the things they teach you is as the yield curve flattens, which means that short rates get really close to what long rates are, that is a precursor of recession. So really all they've done is driven us that much closer. And again, in raising rates in December, they pumped up the value of the dollar because negative rates are all over the globe. So if you want to find some kind of return on your investments, if you will, your fixed income investments, you almost have to do it in the U.S. Well, okay, so you got to buy dollars to do that. And so that's increasing the strength of the dollar, the value of the dollar. And then that bleeds over, like I said, to all these emerging market currencies, particularly China, that are pegged. They've pegged their value of their currency to the dollar. And that puts them under stress. And it really kind of has the Fed in a corner. And like I said, I would never have expected them to try to attempt this little game that they're playing here again in March. But now that somehow the stock market has managed to draw itself back to even on the year, I mean, I can almost see Mother Felon and her little board of goons sitting in a conference room somewhere this morning saying, well, hey, look, we raised rates and the stock market's basically flat. We can do it again. So we'll just see what they decide.
We all know at this point that the market is completely manipulated. I mean, when you look at corporate earnings, when you look at the sales, and you look at the other economic indicators of what's really going on in the economy, like the Baltic Dry Index, manufacturing,
Yeah.
and retail, the real unemployment numbers, I mean, it is a complete mess compared to if you're just looking at the stock market. That looks fantastic. But when you take the market today, and I'm discounting, whatever the high is, the way we're bouncing around on the top right now reminds me of 1929, 2001, 2008, right before everything fell apart. And it
Oh, bro.
seems very similar.
Oh, absolutely, brother. Let me lay this on you. We've been following this TF Metals report now since August,
Hmm.
because it looked as if the market was beginning to roll over in August, and then it did. If you remember that Monday, August 24th, when the Dow only opened up down 1,000,
Right.
and that was due to the circuit breakers kicking in.
Hmm.
Well, prior to that, we were noticing the thing rolling over. And I've written a series of reports since then. In August, we talked about it. We called it a death candle on the monthly chart, a candle being a candlestick chart, and how what you mentioned, stock market rolling over, completing what had been a bull run in 2001 and again in 2008. And the rollover began with one of these big down months. August of 2015 was almost identical in total range and then total change to December of 2000 and in January of 2008. We said, okay, well, if this is going to start playing out as it has before, then what should happen next? Well, in January of 2001 and in the spring of 2008, we had a rally where it was kind of like a relief where like people were like, oh, see, don't worry about it. Everything's fine. That was just an anomaly, just a little small correction. And that's exactly what we had, if you remember, last fall. And again, the bounce back in the S&P last fall was similar in range and in overall positive change to what we saw in January 2001 and May 2008. And we went, boy, that's when we went, oh boy, this is really starting to look the same. Well, now we should probably roll over. And that's exactly then what happened in the spring of 2001. And again, in the summer of 2008, we started to do that in January. What we recognized as being like the final, maybe nail in the coffin, was a bearish crossing of some of the really long-term moving averages on the S&P. They bearishly crossed in, like I said, in the spring of 2001. They bearishly crossed in the summer of 2008. And man, that's when the bottom dropped out, and we ended up with almost a 50% correction. Well, they bearishly crossed at the end of last month as well. So, is history repeating itself? Well, almost exactly it is. But what you mentioned earlier is the caveat to all this. Is in 2001 and 2008, we did not have everything controlled by a computer. We didn't have this clear intention and desire by the central banks and their I guess we'll call it their servants, the primary dealers, to try to keep things afloat, to create this wealth effect, to try to keep everything going. So maybe they can hold it off and history won't repeat itself. But man, I tell you, the resemblance to the prior two market peaks is astonishing.
Yeah, it really is. And at the same time, if we go back to December of 2015, we saw gold was around 1,050. And since that time, we've had major rallies in gold where it completely shot up. And every time it shot up, we see gold suppressed once again. I mean, it
Yeah.
shot up, what, 50, 60, $70. Then it came back down, then it shot up again. And today, actually the last couple of days, we've been seeing gold really come down. But gold is up still, what, like $200 since December of 2015. Where do you see gold going at this point?
Well, a lot of the gold market is also this high frequency trading. And a lot of gold's rally earlier this year was also linked to that rally in the yen. In fact, you can pull up long-term charts going all the way back to 2012 when gold seemed to disconnect from its long-term pattern of tracking the amount of U.S. debt and the U.S. money supply. You've probably seen some of those charts, Dave, where
Yes.
gold kind of tracks with, and all of a sudden QE3 begins and gold completely diverges. The debt and the money supply continues to grow and gold goes straight down. Well, at the same time that QE3 began, The Bank of Japan almost immediately got in there and they started devaluing their currency even at an even faster rate. And gold has tracked the yen. And you can pull up about a 3-year chart and see the two of them following each other down. Well, as the yen began almost a historic rally, I mean, it rallied 10% in about 10 days in early February. Gold just shot up with it. All the while all of this new speculator money was flowing into paper gold on the COMEX, the big banks that I guess we'll call them de facto market makers, the big bullion banks like JP Morgan and HSBC and those banks that make a market on the COMEX for this paper, they were printing new contracts and feeding them to the specs as just as much as they needed to. What makes it kind of a sham is they don't put up new gold. They don't put gold into the vaults and then lever it 5 or 10 times and create new contracts out of it. They just create contracts out of thin air. Open interest, total open interest in COMEX gold, even at the end of January, was only 380,000 contracts. We rallied all the way through February and here into early March, and now we're up north of 500,000 contracts. That's, let's call it 120,000 contracts. That's 12 million ounces of paper gold that these banks have created. But the amount of total gold in deposit in the vaults hasn't changed. So they've just been playing the same old game. They feed the speculative paper or the paper to the speculative buyers. They keep doing it until the speculative buying interest finally dries up. They wait for price to tip over, or they force it to tip over, which is what they've done these last 48 hours. And then they get maybe some news like tomorrow that'll force all of these specs to go rushing to the exits. The specs begin to sell, maybe all at once. Who's taking the other side of that trade? The banks, which are buying and buying back all of these shorts that they issued on the way up. That's how the COMEX works. It's no other markets in the world are allowed to. I mean, think about this, Dave. Think if you owned, I don't know, think of what's a good stock that's been going like crazy. Just pick an equity. And there was fundamental news that was driving that equity up. And the reason it goes up is on any given day, there's really a set amount of shares that are outstanding. And price needs to reset higher to find this equilibrium point where there are equal buyers and sellers, right? See, that's not how it works in gold. You get fundamental news or a reason for these specs to buy. You don't just get the same amount of contracts every day. You get these banks to just simply create new contracts out of the blue and feed them into the market. If they didn't have the ability to do that, who knows how much gold would have rallied even just in this rally. But instead, this game continues to be played. We're at a point now where the banks are at historical extremes in terms of their short position. And so when you see it being levered down, managed down, as we've seen particularly in the last 48 hours, the effort now is underway by the banks to get the specs to panic, to get them to sell, and then use that selling to cover back up all these shorts. It's how it works. Very few people understand that. A lot of people think that, that's a fair price for gold. No, it's a price of the derivative contract is really all it is. It's not really a value of gold at all, but it's the system we have, and it's currently what we're still dealing with.
What is their biggest fear here? Why are they afraid of gold just going to the price that it's supposed to be? Why do they have to continually manipulate it?
I think at the end of the day, Dave, right now, and the reason why they've continued to force it lower and lower, I mean, this is the first time in 3 years we've actually made a higher high.
Right.
I mean, That was really astonishing. When we got through 1190, we got through the highs of last October, and then we got through 1230, which was the high before that. I mean, that was the first time we've done that in almost 3 years. And I have long maintained on my site that the key to keeping this, because really it's a confidence scheme. The paper market is a confidence scheme. I mean, the actual gold, whether it's on the COMEX in the vaults of London, wherever, the actual gold that's there is maybe 1/100th of what the amount of paper obligations that are out in the world. But it's a confidence scheme in that, that's okay. I know that if I ever want my gold, I'll call them up and take deposit. I don't need it. I don't want to store it. I don't want to pay for storage. So I'll keep it in an unallocated account. I'll own the GLD. I'll own a futures contract, whatever. But when the time comes when there's a delivery failure, when suddenly all of the gold that's been absorbed by China and Russia and India, when all of a sudden these banks that are responsible for making these deliveries all of a sudden can't make one, and the person that owns I guess some an unallocated account in Canada or Australia or in England, or the person that owns a GLD thinking that they own gold and they want to take delivery and they find out they can't. That's when this paper system, that confidence that you can take delivery, that's when it begins to disintegrate. And that's what they're afraid of. That's why they've kept price down, because they've somehow been able to manage these last 3 years to meet that almost insatiable demand of the East. But if Western investment demand returns, that's when they really get into trouble. And that's what they've been, because again, the key in the West, most U.S. investors, even in Europe, they only want to buy stuff that's going up, right?
Right.
No one wants to buy stuff on sale. They want to wait until it's already gone up 20%, 30% to buy. And so if you can keep the price trend going down, then you can keep sentiment down. And if you can keep sentiment down, then you can keep physical demand down. And that's what they've been able to accomplish for the last 3 years. But in this move up, you've seen these now huge amounts of allegedly gold moving into like the GLD and all the other ETFs. You've got all these other stories about sales at the U.S. Mint, and lines around the block in London and all that kind of stuff. That's what they're afraid of. That's why they continue to short into it. One other thing, Dave, they've got to protect their proprietary position. Look at it this way. Remember the London whale?
Yes.
Okay, and he got buried under, $5 billion, $10 billion in losses, whatever it ended up being. It's not as if, if you think of JP Morgan, as this evil, nefarious organization, but they got all these different units and all these little trading desks and all these little whales, managing their own little fiefdom underneath the big umbrella. The London whale is the, most egregious example of that. Well, think of a person or a group of people managing the JP Morgan silver short position. They make good money doing it, man, no doubt about it. But here you get down to $15 and whatever. And Ted Butler, who's been watching this stuff for decades, he currently estimates the JP Morgan net COMEX short position to be about 20,000 contracts. Okay? That's 100 million ounces of paper silver. So for every dollar that silver goes up, that's $100 million paper loss. If silver to go to 15 to 20, that's $500 million that they'd be under. So besides all these other things, you got these banks just simply trying to, put good money after bad and protect their positions. So these are all the different things that we fight just because of the way, the system works. The key to ending the system one day is delivery failure, when the metal just simply runs out. How close we are to that, obviously impossible to say, but it will end one day. And then finally, we'll have a more fair system of pricing and valuing physical metal. But for now, we've got to keep dealing with what we have.
There's a couple things that are going to happen this year, like the yuan-based gold price fix, which is going to happen, I think, in April.
Yep.
And we also have China's yuan, which is going to be included in the IMF basket of SDRs, I think, by the end of this year. Are any of these a game changer, or is this going to change anything when this happens?
I don't think in the sense of you wake up overnight and you go, whoa, wow.
Yeah.
I don't think that, but it is evidence of this kind of ongoing shift. I mean, London has been the center of the precious metals universe now for over a century, right?
Right.
And there's this transition away from that. The Chinese are, they're communists as well, but they're also pretty smart people that think from a very long-term perspective. And history dictates that he who has the gold has the power. I mean, that's what's been plundered for millennia, right? When the Gauls move across, Europe or whatever, and they plunder and they take home the spoils and the gold and that kind of stuff. And that's who has the power. And then the Chinese recognize that. And so they've been accumulating. They haven't been exporting anything. They've been rapidly accumulating. No one believes their official stockpile number. There's when you really count into everything that they might have held by the government, by the central bank, by the citizens, everything else. It's only natural that they would eventually want to transition. I don't want to say control of price, but make Shanghai or wherever the new center of the precious metals universe. Now, what they'll do with that, whether they'll eventually back the yuan with gold and create an alternative for the world outside of the dollar, that's a fun thing to talk about over cocktails and speculate. And we've been doing that for years. But at the end of the day, they just simply want to have the power. They'll have the gold, so why shouldn't they have the pricing mechanism? And that yuan daily fix is all part of that. It will also likely expose the shenanigans and provide an alternative to the London fix. Mm-hmm. And so that'll be nice. But again, at the end of the day, it's part of a process. It's not, one of these things where come April 21st or something, we'll wake up and gold will be $300 higher. I'd be very surprised by that.
Where do you see gold going by the end of this year? Where do you think it's going to end up?
Well, in the short term, and we've been talking about this for almost a month now on my site. So I'm giving you a long answer if you don't mind. Okay. In the short term, we have to look at it, from this commitment of traders perspective, from the bank's position perspective again. And again, nothing has changed. There's a lot of, when gold shot higher by 5% back on the February the 11th, so all kinds of folks came out and said, oh boy, the paper markets are breaking and all that kind of stuff. And I was mildly optimistic too, because we hadn't seen a day like that in 5-6 years. And you never see gold move up that much, but yet we did. Well, it was at the same time that the Japanese yen had been melting down overnight to its low as well. So I sat back that week and went, I don't think anything's changed at all. And by the time we got, there was a commitment of traders survey taken on Valentine's Day, I think I'm sorry, not Valentine's Day, it would have been the 16th of February. Got that report on the 19th of February. And then by then it was clear that the banks were just simply playing the same game that we just described, just feeding brand new paper gold to the spec demand to try to absorb it until at some point comes, they can roll price over. They've continued to do that, and I've continued to warn people now for the last 3 weeks that at some point they're going to roll it over. Well, they haven't been able to, and prices continue to drift higher. We got that crazy day back on Thursday last week. Remember that with Draghi and
yes.
And do you remember? And here I'm going to kind of go off on another side tangent for just a second. Do you remember the day back in late January? It was a Thursday night when suddenly the Bank of Japan announced NERP.
Yes.
And the dollar yen, the inverse of the yen, the dollar yen shot higher by 3 points. But like within 48 hours, it completely reversed and began this 10% decline that I'd mentioned earlier. You had this complete, I guess we'll call it a half-life of that Bank of Japan announcement. They tried to weaken their currency, but instead their currency shot 10% stronger, almost immediately followed. Well, Draghi did the same thing last Thursday, attempted to weaken the euro. Here it lasted about 48 minutes. And then all of a sudden the euro shot higher. Gold was immediately sold off, got down to 1237. By the end of the day, it was 1272. Everybody was looking at the chart and seeing, and you've probably seen it, this kind of flag on the daily chart.
Right.
From any, you open up any technical analysis textbook that's been written in the last 50 years, and they'll say that flagpole formation like that, the pole then is half of the rally. So when you created that flag and then broke it and resolved it to the upside, now everybody and their brother's talking about 1450 gold because they had another $200 to go. You had that day Thursday when you had this huge reversal and central bank confidence is down. We had this opening of Asia Thursday night in the U.S. Friday morning. We opened at 1284, $12 higher. Okay, so you've got positive fundamentals that we know about all this demand. You got positive technicals with the resolution of that flag, that pennant. You got a breakout to new highs. And what happened next? It was immediately set upon by the banks. They said, well, this is as far as we're going to allow this to go. The price was immediately sold off overnight, tried to rally into the open. It was smashed right about the time of the London fix, 10 o'clock New York. It then traded sideways in about a $2 range for 5 hours on Friday. once the COMEX was closed, it was electronically trading on the Globex Friday afternoon. Nobody's around. There's no offers, no bids, very light volume. And all of a sudden it smashed for another $10 an hour before the New York Stock Exchange closes, so that can impact the miners. We get a little bit of a rally Sunday night. Boom, as soon as the COMEX opens. Bang, after the COMEX closed yesterday. Boom, again last night, down another $6 in a couple of minutes. And now here we are, $50 lower than where we were on Thursday. Everything looks great. And now we're $50 lower. All you're seeing, again, is these banks that had enough. They were riding it out, kept feeding the paper. Open interest last Thursday went up by 15,000 contracts in one day. They printed nearly, $1.5 million ounces of paper gold, trying to keep a lid on things, keep it from breaking out. Once it finally broke out, they had to act. So now we're down $50. Clearly, everybody's being set up for a washout, very likely a washout with whatever the Fed announces tomorrow. They're going to try to beat it back down to where the moving averages are way down. The 200-day moving average is way down like $100 below here. You're going to try to at least get it back down there, I would imagine. But anyway, to ultimately answer your question, I think we have seen a sea change finally. We've seen a real sentiment change. And there's this decline, there's this loss of confidence in central banks that is kind of underlying all of this, that I think ultimately keeps the banks on their heels. Absent a delivery failure, absent some kind of breakdown of this confidence scheme, it's going to be really hard to see gold shoot dramatically higher. But I also don't think we're going down to make new lows. All the people back at the beginning of the year saying, oh, gold's going, to triple figures. I don't see that happening either. It'll probably continue to be this 3 steps forward, 2 steps back. But, as we've been talking about for a couple of years now, anything under $1,200 is a pretty good buy. And that'll ought to continue to be the case.
So on the economy right now, in your opinion, what do you see at this point moving forward? Do you think the economy is still on the trajectory that we're going to completely go into a recession? Some people say we're in a recession. Some people say we're in a depression already. Where do you see the economy at this point, and where do you think it's going to as we approach the end of this year?
I don't think there's much chance it can improve as long as negative interest rates are so, that's the policy of the Bank of Japan and all across Europe. Because what's happening is, regardless of what the Fed wants to do and try to convince everybody that everything's okay and the wealth effect, the stock market's hanging in there on all that kind of stuff. Like I said, Econ 101 says a flat yield curve or even an inverted yield curve. Go back and look at 2007 and 2008. The yield curve began to invert, which didn't prompt the real estate bubble bursting, but it certainly didn't help. That's where we're headed now. Again, with negative interest rates around the globe, dollars are bought and investments are made. That's why the 30-year long bond has fallen. That's why the 10-year note has fallen, even while the Fed is allegedly raising rates, because people are, hedge funds and institutions and banks are all looking for yield and they're buying U.S. debt. So all they're doing is flattening the yield curve, which means if we're not already in recession, it's only going to get worse, which eventually is going to lead the Fed back around, which is, again, why they're so desperate to try to raise rates, is that they can eventually cut them. Because when you're at zero, the only move the Fed would have is to go to negative. And so none of this, I don't see any of this getting better. And all it does is it continues to bolster the fundamental case for at least owning some physical gold and silver.
For my last question, do you think the economy's set up to fail the way 2008 failed, or do you think it's going to be much worse than 2008? Because what I see is bubbles in the auto loan industry, bubble in the student loan, bubble in real estate, bubble in the stock market, bubble in the bond, in derivatives. We really didn't have this type of bubble type of world back prior to 2008. People, own their homes, they had equity in their homes, and today people had, back then they had jobs. Today we're seeing the complete opposite of what happened, but kind of similar activities occurring at the same time, where we see people, they don't have jobs. The auto industry is being pumped up, and these subprime auto loans are being packaged just like the real estate subprime was being packaged. The stock market is manipulated even more so today. And we're seeing all of this happen at the same exact time. And this time, to me, what everything that I've been looking at seems like we're heading in an area that's going to be much, much worse. Do you think it's going to be much, much worse than 2008?
It really feels like the next time, well, what will they be able to do? Again, you mentioned derivatives, the size and the scope of that, and they'll
Right.
say, well, somebody's a party and somebody is a counterparty and it's all offset. No, that's no. And the size of it is so large that a meltdown, I mean, how are they going to do it this time? I mean, how many dollars can they print? And then there's this, what do they call it? Modern monetary theory that says, hey, as long as you are printing currency to monetize your own debt, what's the problem? And then there's like a whole people thought that was crazy 20 years ago, and now all of a sudden you're reading folks that are seriously analyzing that, thinking that that's okay. So we're probably very likely headed down that kind of path. Then, especially if there's some kind of seize up of the system and derivative meltdown, and you mentioned all of the subprime, the student loan, the subprime auto. I mean, they're now selling auto loans where they'll if you're underwater in your car, they'll pay off that. And so now your it's a $30,000 car. You drive it off the lot, it's worth 20, but you owe 40. I mean, that's how they're perpetuating auto sales. I mean, it's just madness. It's just, and they can keep these plates spinning for a while, but eventually, it's just gravity takes over. And so that's where we're headed. And again, against this madness, you've got to own at least some. You don't take all your money and put it all in gold and silver. Just want to take all your money and put it in anything. But you got to own some. And you must make sure that it is your own, that you can hold it in your hands and put it in your safe or wherever you keep it. Because if you own this paper stuff, if you have an exposure to gold, you don't got squat. And the day's going to come where the music stops and you're going to think you own gold and you don't. You're not protected. So while you can still lay your hands on it, you should be taking that time now to do it. Again, I don't know when all of these events are going to happen, but we're certainly still headed in that direction. And you just got to be using this time to prepare.
Craig, thank you very much for being on the X22 Report Spotlight. Once again, how can people get in touch with you and see your work?
The site is tfmetalsreport.com. We've been around for, 5.5 years now. It's a great community of like-minded people. We're all there to help each other. And if you want to go into greater detail with podcasts every day and look at the chart and all these other reports, it's a whopping $10 a month. So it's not like, we're trying to scalp people for $100 a month or something. It's $10 a month, helps me keep the lights on. And I think people find it pretty valuable. So tfmetalsreport.com.
Craig, thank you very much once again.
Hey, anytime.